So our topic is income statement, and in this group is Audrey, Jordan, Jessica, and Stephanie. What is the income statement? An income statement is a financial statement that reports a company's profit or loss over a specific period of time. It includes the following: sales revenue, which is revenue from sales of goods or services; cost of sales, which is also variable costs and cost of goods sold. That is reflecting the cost of inventories purchased for resale. Expenses, that is assets consumed to produce sales revenue. And gross margin, which is sales revenue minus the cost of sales. And break even, which is total sales equals total costs after taxes.
The next part of the income statement is sales revenue, and sales revenue equals cost of sales plus expenses. When cost of sales and expenses equal sales revenue, that's when you hit break even. Net income versus net loss is another part of sales revenue, and net income is when sales revenue is greater than cost of sales plus expenses. Net loss is when the sales revenue is less than the cost of sales plus expenses. We have two examples. First example is when the cost of sales equal $5,000 and expenses are $3,000. Will you find sales revenue? And sales revenue equals $8,000. The second example we have is when the sales revenue equals $200,000 and expenses equal $40,000. How do you find cost of sales? Cost of sales will then equal $160,000. There are 5 total sections of the income statement. These sections are income, which is also known as sales, your direct costs, variable costs, your gross profit, fixed costs, as well as net loss and net gain.
Here's an example of an income statement. The income statement is divided up into different parts. You have the item, the dollar, the percentage, and notes for your benefit. The first part of the income statement is sales or revenue, and in this example you have $100,000 of sales revenue. This is 100% and will always be 100% because you're dividing, or your total would be your sales revenue. Next would be variable cost or cost of goods sold, and in this example is $25,000. And that would be 25% of your sales revenue because you're dividing your dollar of your variable cost divided by your sales revenue, and that will give you 25% variable cost percentage. Next is gross profit, which you get from subtracting variable costs from your cost of sales, and gross profit is also called the contribution margin. In this example, it would be $75,000 because that's $100,000 minus $25,000, and it's 75%. You get that from 100 minus 25, or taking $75,000 divided by $100,000. After that would be fixed costs. These are your expenses that don't change based on your sales, such as rent. And in this example is $10,000, and you don't typically have a percentage of sales because it is a fixed cost. After that, you get net profit and loss. You get that by subtracting your fixed cost from your gross profit. And in this example, your net profit is $65,000 and 65%. You take your gross profit minus your fixed costs to get your net profit. If you make a profit, then you subtract your tax, and in this example, it is 1%. So 1% of $65,000 would be $650, and you would only take your tax out if you made a profit. In order to get your net profit after tax, you subtract your tax from your net profit. And in this example, that would be $64,350.
So here's another example of an income statement of a landscaping company. It is 3 months long and ends in March of 2006. So in this example, they don't really have any variable costs or cost of sales, so you just have the revenues and the expenses. They did not calculate tax in this example, which is okay. You only account for taxes every now and then or when the question asks you to do so. So you do your total revenues minus your expenses, which is $9,050 to find your net income. So this is the handout that we have given you, and it just breaks everything down. It shows the red is subtraction, so sales revenue minus variable costs or cost of goods sold equals the gross profit. And then the gross profit minus fixed costs gives you the net profit or net loss. Remember, you only subtract taxes if you have a net profit. If you have a net loss, you do not have to pay taxes. And we have also broken this down for you on the notes portion.